The Motley Fool is a platform which provides financial planning advice and even investing advice. It gives you different tools such as expert articles or even a stock advisor which has clearly outperformed the S&P 500 in the past 20 years. As you can see in the chart, the blue line is the stock advisor which was created by the Motley Fool, and the gray black line was the performance of the S&P 500. The performance of this stock advisor has been 542% since 2002, which is almost 4 times that of the S&P 500. And out of all the stock picks it has provided, 64% of them have been profitable. Just to give you a few examples, it recommended these 4 companies. In 2004, it recommended Amazon, which has returned over 19,000%. It also recommended Netflix, which has returned over 25,000%. Then Disney in the same year, which has returned over 5,000%. And one of its biggest winners in 2005, it recommended Nvidia, which if you bought the stock in 2005 and you held it all the way up to today, you would have made over 28,000% in your investment. So we should investigate how this method actually works, who the people behind the Motley Fool are, and what we can do to actually obtain similar returns when making investment decisions. So this was created by David and Tom Gardner, the creators of the Motley Fool. My favorite quote from them is one they repeat in almost every single interview they have, which is, "Let your winners run." And this actually goes hand in hand with a quote by Peter Lynch, which said, "You should not water the weeds and cut the flowers." And this refers to that you should not invest more capital into the companies which are decreasing in value, and you should not take profits from those companies which are actually performing well and compounding over time. David and Tom recognize that investing is not a one-size-fits-all strategy, which is why the Motley Fool, they have tried to actually explain everything in a way where every investor and every user can obtain some value from it and apply it to their personal investing strategy. They also say that while it is fun to follow the daily market, long-term commitments are where the true value lies and where the true money is made. They believe that a diversified portfolio is essential, but it should have a degree of concentration, because if you have a diversified portfolio with over 100 stocks, it will be very hard for you to track how each company is performing individually. So they believe that a number at around 25 companies to track is the proper number, at least for beginner investors. And they also said that it doesn't take many winners for you to become wealthy. If you have a stock portfolio of over 25 and the majority of them are stable, if you have 2 or 3 stocks that are 10 baggers, you will be one of the greatest investors in terms of absolute returns. Their philosophy is very simple. They have 5 main characteristics which they want to explore, or they like to actually dive deeper into when analyzing stocks. The main pillar from this philosophy is the management. This is very contrary to the philosophy from Warren Buffett, as he says that he likes to invest in companies that could be run by themselves. However, following the Motley Fool's philosophy, they like to invest in companies where the management has clear skin in the game for the long run. What does this mean? Well, the CEO must be in a position where, for example, the majority of their salary comes from stocks or from options, which will expire in the long term. This ensures the investor that the CEO will try the absolute hardest to increase the stock value and to improve the position of the company for the following 10 years. This is a problem in the majority of the companies, as a lot of CEOs, in order to accomplish their objectives and get the majority of the salary for themselves, may even dilute shareholders, may sacrifice long-term strategic decisions for shorter-term one-offs. The second one is the long-term. And this I could not agree more with, because they have an approach and a strategy where you should think of investing as a long-term project where you will be doing this for the rest of your life. This is not a get-rich-quick scheme. This is more of a get-rich-slow scheme. As you have seen in one of the previous slides, they have made astonishing returns with Amazon, with Netflix, with Disney, with Nvidia, and with 1,000 other stocks. However, this has been over the time course of more than 16 years. They bought, for example, Amazon in 2004, and they have not sold it yet. So they've been holding Amazon for close to 20 years, and they have not taken any gains yet. They have instead been investing more money into it. The third one goes again with Peter Lynch's and Warren Buffett's view, where you should focus on your circle of competence. You should invest in industries you understand well. Fourth one is to focus again on disruptors. You should focus on first movers to new industries, or even focus on those who defy the status quo. As you have seen, they're major winners. 3 out of the 4 ones that were presented are either first movers or disruptors of industries. And finally, you should buy the business, not the ticker symbol. You should forget about the stock, forget about the price movements, forget about the noise, all the opinions and the bad news coming out. You should do your own due diligence, make sure that the business has proper fundamentals, and if it actually matches your investment decision or your investment strategy, go for it, believe in yourself. And again, this is a long-term strategy, so you will have to redefine your strategy and improve as you go along. So there are 6 points to consider. Before we move on, I just want to say that this is not financial advice. I'm not a financial advisor. These are some points that I have seen that have made the Motley Fool so successful. There are 6 of them. I condensed them down a little bit. But the first one, for example, is they say that you should buy more than 25 companies. They say that 25 is the perfect number for a beginner to mid investor, but that you should not rush to buy these 25 companies. They also like to focus on quality over quantity. However, they do believe that diversification is great. As they say, 3 great stocks is all you need. Number 2 is that you should have a hold period for longer than 5 years. You should be investing as if the stock market were to close tomorrow and you would not be able to look at the stock again for the next 5 years. Would you feel comfortable holding that investment? Again, you must give the investment time to play out. If your investment thesis is correct, it will not play out in 1 year. You have to give it time. Number 3 is that you should be constantly adding new savings to your account, either by dollar cost averaging, which basically means buying the shares of companies you already own when the price is considerably lower, so you can decrease your cost basis and in the long term improve your overall return. Number 4 is that you should ignore volatility. Nowadays, more than ever, there is an overload of data, an overload of noise, especially in the stock market. I have heard before that investors are driven by fear more than they are driven by positive news. So you should ignore the short-term moves, as they do not scare a good business. Amazon, for example, which is one of the greatest winners of the Motley Fool, has ignored the different recessions it has taken part of, has ignored all the different scenarios, all the different bad news that they have published about it, and is now one of the greatest, most important companies in the whole world. Number 5 is that you should let your winners run. As we said previously, you should not water the weeds and cut the flowers. You should do quite the opposite. If anything, you should cut the weeds, meaning that you should sell the companies that are doing badly and just add more capital to those companies which are flourishing and providing the majority of the returns for your portfolio. But remember, you should always stay diversified, because that is the rule that the Motley Fool has taught us to do. And number 6, long-term returns. In the end, your investment thesis will create value in the long run, so don't forget about that, and always remember that this is a lifetime process and you should learn to enjoy it and become a better investor, person, and professional in that way. Some important information for effective investment. The 3 main takeaways from this, the Motley Fool's philosophy, I would say, is first of all, this is a long-term lifetime process. This is not a get-rich-quick scheme. If you go into it with that mindset, you will probably lose money in the long term. Then you should create your own personalized investment approach. Don't just take advice from anyone you see on YouTube, any recommendation you see on an article. You should create your own strategy and do your own analysis before making an investment. And finally, you should focus on your circle of competence. Don't invest in companies that you don't understand, because in the end of the day, if anything goes wrong, you will not know when to sell or when to keep holding. So as always, this has been the Cashflow Compounder. Thank you for watching. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.